Most people evaluate financial decisions by asking one simple question: can I make the payment? But sophisticated systems do not evaluate decisions that way. Sophisticated systems evaluate liquidity, solvency, leverage, survivability, recurring obligation load, and future optionality. A decision that appears affordable today may structurally weaken the households tomorrow. And from this point forward in the series, we stop looking at financial decisions emotionally and begin evaluating them structurally. Up until this point in the series, we built the accounting system. We learned accrual accounting, timing differences, reconciliation, the accounting cycle, financial statements, liquidity ratios, solvency ratios, and the relationship between cash reality and economic reality. But now we move into the next phase. We begin using the system strategically. This episode introduces the formal household operating dashboard. And from this point forward, every major decision will be routed through this dashboard. A vehicle purchase does not simply create a payment. A mortgage does not simply create shelter. Lifestyle expansion does not simply create enjoyment. Every major decision reshapes future liquidity, future solvency, leverage, survivability, optionality, and future freedom. And this is why two households with identical income can possess radically different financial resilience. Here is our household operating dashboard. This dashboard becomes the measurement layer of the household operating system. It allows us to evaluate fragility, resilience, recurring obligation pressure, financing dependence, and future survivability. From this point forward, we will stress test decisions through this framework. Many households focus only on gross income, but the operating system focuses on the stability of income, the recurring nature of income, contribution margin after obligations, and how much operating surplus remains after the system supports itself. Key dashboard metrics include gross income, net income, household operating surplus, free cash flow to household, fixed obligation load, variable spending capacity. In corporate finance, operating leverage measures how fixed operating costs amplify changes in profitability. Households behave similarly. The more fixed lifestyle obligations a household possesses, the more fragile the structure becomes, and the more income volatility becomes amplified. Examples of lifestyle leverage include luxury vehicles, expensive housing, recurring subscriptions, tuition commitments, lifestyle normalization, and rigid recurring spending. The more fixed obligations embedded into the system, the greater the sensitivity to income shocks. Degree of lifestyle leverage measures how changes in income amplify changes in household operating surplus. Debt changes the operating structure of the household. Interest expense introduces recurring claims on cash flow, refinancing risk, interest rate sensitivity, and survivability pressure. Financial leverage amplifies outcomes. In expansionary periods, leverage can accelerate wealth accumulation. But during stress periods, leverage compresses flexibility and magnifies fragility. Examples include mortgages, vehicle financing, home equity line of credits, consumer debt, and leveraged lifestyle expansion. When high lifestyle leverage combines with high financial leverage, the household becomes structurally sensitive. This creates what we think of as a fragility multiplier. A household may appear wealthy externally while possessing low survivability, low liquidity, weak coverage ratios, and very limited optionality. This is why surface appearances often fail to reflect structural financial reality. Liquidity is not simply money. Liquidity represents adaptability, survivability, and time. The greater the liquidity position, the greater the ability to absorb shocks, adapt to uncertainty, and preserve future flexibility. Core liquidity ratios include the current ratio, quick ratio, cash reserve ratio, survival months, and operating cushion ratio. This dashboard allows us to evaluate how long the system could survive under stress. One of the most important household metrics is survivability. Not appearance, not status, not even income. Survivability. A household with high liquidity, low fixed obligations, and strong operating flexibility possesses far greater resilience than a household with high visible consumption but weak liquidity. Liquidity determines short-term survival. Solvency determines long-term survivability. Key solvency metrics include debt-to-income ratio, debt-to-equity ratio, net worth trend, fixed obligation burden, financing dependence, and debt servicing structure. These metrics allow us to evaluate structural pressure, leverage intensity, and future refinancing vulnerability. One of the most important financial resilience metrics is the interest coverage ratio. This ratio measures the household's ability to support interest obligations using operating surplus. As interest expenses rise, flexibility falls, survivability weakens, and financial fragility increases. This becomes especially important during variable rate environments, refinancing periods, recessions, and income shocks. The total debt servicing ratio measures the percentage of gross income consumed by principal repayments, interest obligations, and housing-related obligations. Most people encounter this ratio only during mortgage approval, but structurally, it is actually a recurring cash flow rigidity metric. The higher the ratio, the less adaptive the household becomes, the more compressed future optionality becomes, and the more sensitive the system becomes to shocks. This framework uses accrual accounting, which means we distinguish between economic reality and cash timing. But cash flow still matters tremendously. The household operating dashboard therefore tracks cash flow from lifestyle activities, recurring income generation, recurring expense structure, and operating cash production. The cash flow from investing activities, vehicles, homes, investments, education, and productive assets, and the cash flow from financing activities, debt issuance, refinancing, loan repayment, mortgage financing, and lease structures. One of the most important warning signs in household finance is financing dependence. If the household repeatedly requires refinancing, new debt issuance, balance transfers, or expanding credit usage, the system may not be structurally self-sustaining. Strong systems eventually generate internal surplus. Fragile systems increasingly rely on external financing. From this point forward, we will run major life decisions through the dashboard. Upcoming decision simulations include vehicle decisions, leasing versus financing, new versus used, luxury versus utility. Housing decisions, rent versus buy, mortgage structures, variable versus fixed rates, down payment structures. Lifestyle expansion, subscriptions, dining inflation, recurring commitments, lifestyle creep. Debt decisions, refinancing, home equity line of credit usage, and consumer leverage. Income shock scenarios, layoffs, recessions, inflation, interest rate increase. And lastly, investment decisions, liquidity preservation, emergency reserves, and productive capital deployment. A strong household is not defined by appearances. It is defined by survivability, liquidity, solvency, flexibility, and preserved future optionality. And from this point forward in the series, we begin operating the household like a strategic financial system. In the next episode, we begin stress testing real-world decisions. We will examine vehicle financing, depreciation, insurance, maintenance accruals, debt service pressure, liquidity deterioration, and the ripple effects vehicle decisions create through the entire household operating system. Because a car is not simply transportation, it is a long duration cash flow architecture decision. And we're about to measure its true structural cost.